I'd like to discuss the difference between the term average market returns versus actual market returns. This term, average market returns, is what we hear all the time. It's also what you see when you Google Dow Jones or S&P, is the average market returns. And what I want to show is that, well, it means rather nothing. Actual is what we want. This is how much money we actually put in our pockets at the end of the day. Before that, though, I want to go into what I almost always begin these with, which is discussing quickly the functions of money. There is the banking function. This is where we warehouse or borrow money. There's also the investing side, and this is where we're trying to increase our cash flow, whether through investing in real estate or stocks or paying off debts. The whole point is to increase our cash flow. Then obviously there's the spending function of money, and what we need to remember there is that all spending has an opportunity cost. The focus of this video, though, is going to explain the differences between average rate of return and actual rate of return. The actual rate of return for a high cash value insurance product is much higher than what is on the face value of that policy. And that becomes what I call a threshold or opportunity cost. And how is that? Well, you get the part that's in the prospectus, which is the 4 to 5% guaranteed. With the companies that are out there that my wife works with, they've all been paying dividends between 0.1 and 1.5% for over 100 years. So to think that you're not going to get a dividend isn't very likely. But they also always come without fees, and depending on your tax bracket, whether it's 15 or 35, it doesn't matter. All of the growth inside of your policy is tax-free. Another thing I want to discuss is the different categories of money. There is the taxable category of money or bucket of money, and this is our regular income from our regular jobs or dividends from our investments. This is all taxable bucket of money. Then there's the tax deferred bucket of money, and this would represent, say, the 401k or the IRA that you have at the office that you put into and your company matches. That's all tax deferred. And then my favorite bucket, the non-taxable bucket of money, and this is, say, a death benefit or loans from a high cash value insurance policy. All of this is tax-free, so the non-taxable bucket. I'm recording this during the middle of the COVID-19, the beginning of it. Well, who knows whether it's the beginning, the end, or the middle, but we are in the throes of COVID right now. February 12th, 2020, the Dow Jones hit its peak at 29,551. 5 weeks later, it dropped on March 23rd to 18,591. This is what it did. 37% drop. So if you had $10,000 in the market, 5 weeks later, you had 6,300. Now that it's at the bottom, 18,591, right? It has grown over the last 5 weeks back to 24,633. If I go to a percentage change calculator on the web, we're going to see that that's about a 33% increase. So when I did that and I looked at it, I thought, well, that's just barely over halfway back to where we wanted to be. Why is that? Well, when it dropped and our 10,000 became only 6,300, 33% increase on that takes us to 8,379. Well shy of the 10,000 that we were at a little bit ago. And to get it back up to the 10,000 is going to take 59%. And a lot of us don't understand that. What took 37% to lose takes 59% growth to get back. Let me explain it a different way. Let's say year one, you've got 10,000. You've got $10,000 in the stock market, and it earns a phenomenal 100% rate on return. So your 10,000 has just grown by 10,000. You now have, at the end of the year, $20,000. But in year two, you lose 50%. So your 20,000 loses 10, and you end up with 10,000. Simple math, right? You're back at 10,000. But what is your financial advisor going to tell you that he just got you for his returns? He's going to tell you that he just got you 25% average rate of return. And you're thinking, what? Yes, this is what I call financial advisor or Wall Street math. And this is what we get the wool pulled over our eyes with all the time. This is an average mathematical arithmetic average of the returns. So what they do is they take the 100% earnings rate here, they add the 50% negative rate here, and come out with a total positive of 50%. Then we divide the 50% by the number of years, 2, and we get an arithmetic sum of 25%. So when you hear your financial advisor tell you that they can get you a 25% average rate of return, or a 10%, or 11, or 8, or whatever the number is, as long as they're talking about averages, understand it means nothing compared to what you actually put in your pocket. And that's why I call it wallet math. Because the actual or internal rate of return would have been 10,000 positive plus a negative 10,000, which equals 0. You put nothing back in your pocket. And that is the difference between what we're told we can get on Wall Street and what we actually get on Wall Street. Let's look here at the average arithmetic rate of return for the Dow Jones over the past 20 years. In other words, a negative 6.26 plus a negative 5.38. You get the idea, all the way down for 20 years, and then divide that by 20, and you get 5.76. With the S&P, you get a 5.60. But this is only the average arithmetic. It is not the actual. Okay? So this is just a mathematical sum of the percentages divided by the number of years. To look at an actual rate of return, we have to put money in there. So I'm going to pretend that we started with $1 million in the year 2000, right there, okay? And that year it earned a negative 6.26. And we can watch that go all the way through. The actual return over 20 years is not 5.76 that we're told the Dow Jones made, but instead 4.77. But neither of these numbers is the real deal, because neither the average nor the actual includes taxes and fees. And you cannot invest in Wall Street without taxes and fees. Well, I guess you can do it in taxes if it's a tax-deferred bucket, but we're going to use an example here where somebody's putting their money in with an advisor. And the reason I'm doing this is because some friends of mine said, well, our advisor says he can get us 11% versus an insurance product which can get probably about 5% guaranteed for these two individuals, okay? So I wanted to explain the difference between an actual return in an insurance policy of, say, right near 5% versus an average return in the stock market where taxes and fees exist. So the first thing I did was I put in the miscellaneous fees, and I chose 1.5%. Why on earth did I choose 1.5? You might ask, why? How do you know that that's a half decent number? How do you know that someone that's putting money into the market is paying 1.5% in fees? Well, I'm taking my numbers from a Forbes article called The Real Cost of Owning Mutual Funds. So I am making some assumptions here. One, I'm assuming that you're putting your money into mutual funds and not actually doing your homework to choose companies that you feel good about. You're doing like most and just throwing it into a mutual fund because it gives you a number of different companies to average gains and losses across. So in this article, they talk about expense ratio, and it's at about 0.9%. Interestingly, this is the part that you see on our prospectus. This is the part that most people think they're paying, most investors think they're paying, and they don't understand that there are other costs besides this 0.9%, like transaction costs, which come out to about 1.44%. Tax costs, 1 to 1.2%. Cash drag. This is where your mutual fund manager has to keep some liquidity, some cash back just in case, right? And that's coming out to about a 0.83 drag on your total profits each year. Now, this one is the one that is not calculated when they do the summary, and it's called the soft dollar cost. And this is where it's kind of a quid pro quo. Your mutual fund manager is going to use a broker that gives him free services and research. In exchange, the broker gets the business of your mutual fund manager. And we're told that that can come up to about $1 billion annually, or 40% of all equity trading costs. And as it says, it effectively keeps the costs out of the public's eye. We don't see it. Another one is your advisor. You will see this one. Your advisor is going to charge you anywhere between 0.25% or 2.5% for your entire portfolio's balance. That's the average there. So when Forbes summarizes this article, they take both the advisor percentage and the soft dollar costs, and they exclude them. So if your money is in a non-taxable account, like a tax-deferred account from your company, you're probably paying about 3%. And if it's taxable, in other words, you're putting in money every month or every year with your financial advisor, you're probably paying about 4% of that. So when I choose 1.5, I want you to understand I am being very conservative. We also then, and look what happens. We go from an average rate of return of 5.76, and we add in the miscellaneous fees, both the hidden and the non-hidden, and we get about a 3.2% actual return on this portfolio. Add in the tax bracket of 25%, and look what happens. Now we go from an average rate of return of 5.76 to 2.59. Let that sink in. It's almost half the money goes in taxes and fees that we're told the Dow Jones has made over the past 20 years. But some might say, wait a minute, Eric, you chose your 20 years back. It just happened to be that's when 9/11 happened and the markets crashed. Absolutely. So let's go back 30 years. And yes, it goes from 5 up to 9%. So let's use those numbers instead. It's better. Another thing I want to discuss that we sometimes hear but we don't understand is annualized rate of return versus annual rate of return. When your financial advisor says a stock or a mutual fund has averaged 9.5 over the years, what they're saying is the annualized rate of return. In this case, the 9.05 is an annualized rate of return. In other words, smoothing out all those numbers over a 30-year period. Whereas an annual rate of return, say in 1995, would have been a positive 34%. Huge. But in the year 2008, that would have been a negative 38%. So what drove this video was some friends were told by their financial advisor that he could get them an 11% return on their money. And I thought, well, he's not talking about an annual rate of return because we're right in the middle of the COVID thing and the entire market just crashed 37% and then grew back up 30 and then dropped again. This is a very volatile year. So annual returns this year, I don't have any clue how somebody could pull out of their hat an 11% unless they're talking about an annualized rate of return over 20 or 30 years. But my friends are looking at just setting their money someplace until they find some real estate. They're selling some real estate. They're going to have a good chunk of money and then they want to buy some more real estate. And they're wondering where to put the money in the interim. And I was thinking the market this year might not be the right place. But again, it was their financial advisor's statement that he can get him an 11% average. And I'm thinking he must have been talking about a prospectus that gives him an annualized rate of return of 11%, which is better than what the markets have done traditionally over the last 30 years. But I doubt in any way, shape, or form that in this year, 2020, in the middle of May, that he's thinking annual rate of return, but an annualized rate of return. So what we want to do here is once again put in real numbers. So we're going to put in $1 million. And we're going to look at what we were told was the arithmetic average return of 9%, throwing in the Dow Jones numbers for 30 years, and watch what our $1 million does, up and down. And that's 9.5. But when we actually put in the dollars, like I just said, we get an actual return, and that turns out to be 8.07. So when you actually put in real numbers, real dollars, instead of just averaging these percentages, you get 1% lower. So again, the average ends up being about, in this case, 1% higher than what is actual. But actual, in this case, still didn't include miscellaneous fees nor taxes. So when we add in the miscellaneous fees at 1.5% and a tax bracket of 25%, we see that this average return on the Dow over 30 years of 9.05 really turns out to be about 5%. So it loses about just over half. Now, some might be saying, wait a minute, who has $1 million to just go throw and sit there for 30 years? Good point. So let's see what would have happened if we had used dollar cost averaging. Besides, dollar cost averaging is going to be much more akin to what we would do if it was an insurance policy where you're paying every month or every year on an insurance policy. So what I said is, okay, let's use those same 30 years from the Dow, right? And this time we're just going to throw in $10,000 a month. And we're going to see what happens over time with $10,000 a month instead of just starting with the million like we had done earlier. And lo and behold, our average with $10,000 a month still comes out to 9.5, but our actual drops to 4.78. Again, this is using the assumption that we have miscellaneous fees of 1.5 and a tax bracket of 25%. So when we compare the two, dollar cost averaging 4.75, you're looking at a 47% less return than what you're told. So we'd get advertised, well, I can get you an average rate of return of 9, but the reality is it's about 47% less, or 4.78. And if we could do the buy and hold where we just threw $1 million into an account or 100,000 into an account and just let it sit there for 30 years, you're looking at about 45% less than what's actually advertised. So when my friend's financial advisor said he can get them 11, they probably need to cut that number by somewhere around here and get a reality check, okay? So if that's what your financial advisor says, well, I can get you 11% and you can keep your money liquid, or 100% of your money liquid, I would have a couple questions I would want to ask him. One, is this an actual internal rate of return, this 11%? Right? Does it come with guarantees of a minimum growth of somewhere between 4 and 5, right? Is there any fees tacked on to this 11%? And is it going to grow tax-free? Or is this an average? Is this 11% an average rate of return before taxes and fees? You see, we have to compare the two buckets on an even scale. So let's look at what just happened. We did that, right? 11% in COVID. My friends are about ready to sell a home and get, let's just say for argument's sake, about $100,000. In mid-May, after what's going on with COVID, where would you put your money? In a market? If you're a risk person and you're like somebody I know that's like, wow, the market's just, it's a fire sale, buy all you can get. All right, throw it in there. But please understand, this is a volatile annual year due to this. I would also want to ask the financial advisor, how much of that 11% is going to go to taxes and fees? Because he's talking about the taxable bucket and not the non-taxable bucket. So what we've just shown you is that with Wall Street math, when you're told that you're going to get about 9%, you're really only going to end up with about 5% after taxes and fees. Whereas what I want to show right now, with a high cash value insurance policy, when you're guaranteed 4 to 5%, you're really going to end up with about 9%. Let me walk through some real examples of the non-taxable bucket and how it works differently. This is a 44-year-old male. He's a non-smoker. This is his actual policy breakdown. What I'm assuming here is that this gentleman is putting in $20,000 up front to kickstart the policy and $1,500 a month after that. So kind of like the dollar cost averaging where he's putting in $1,500 a month. So that's where we get the $38,000 in year one. And after that, $1,500 a month, or $18,000 a year moving forward. Note also that at age 65, this gentleman quits putting in any money. So for 21 years, he puts in money. After that, no more premium outlay. The policy just runs on its own. Also note, this is the actual internal rate of return. This isn't an average. This is the actual. And look what happens during his life. What I've done is I've run this out to age 89. Why 89? Well, because that's what the average person, male, in America is now living to, somewhere between 87 and 89. So after 45 years with this policy will have earned 4.89% internal rate of return. And by the way, this number here does not represent what happens only in year 89, but every single year that he's owned this policy, it's as if he's made 4.89. Let me show you how that works. This is, as I just said, an actual internal rate of return, 4.89. No taxes, no fees. Let's see how that would work. So again, back to a futures calculator. I built it the same way. 20,000 up front plus 18,000 a year afterward until the 21st year when he turns 65. Then he puts nothing in all the way for the rest of the 45 years. I don't show all 45 years because I wanted this to fit on one sheet and have it big enough to see. All right. And what we will note is that this is an internal rate of return of 4.89%. That's what we put in there that we wanted it to grow at for all 45 years. And that takes us to $2.26 million. And if we come back here to looking at his insurance policy, again, 45 years of 4.89. So the same internal rate of return, this one showing it happening every single year, this one showing what it is at age 4 or after 45 years, but what it's representing is 4.89 the entire time, not just in his 89th year of age, okay? And we both of them come up with the same amount of money, $2.26 million. So what I want to do here is 45 years of 4.89, a tax bracket of 25%, and add in the miscellaneous fees so that we can find out what the real true rate of return would be in the stock market. Okay, so I come over here and I hit the show rate of return, and it's going to give me the average and the actual. So if the stock market were giving me 4.89 as an average rate of return, and I throw in the taxes that I have to pay and the miscellaneous fees every single year, my actual return turns out to be 2.49, much less than what was in the insurance policy. So what I want to do is make this grow so that I can get an actual rate of return equal to what an insurance policy would give me at 4.89. Fair enough? So running those numbers, what I would have to get is an 8.1% return. So this 44-year-old would have to be able to get 8.1% in the market every single year, year after year, with no fluctuation, to return to him an actual return of 4.86, right next to the 4.89 that we were looking at. See the difference when we can compare two different types of buckets, a taxable bucket to a non-taxable bucket? Now these two buckets, because we've added these two columns, can be analyzed accurately. This again, the Dow Jones for 20 years, 5.76 average rate of return, 5.6 for the S&P. And what we're saying here, what this calculator is telling us, is that we would have had to have gotten 8.1 every year with none of this volatility. And if we were able to get an average return of 8.1, it would then give us a 4.86 return here, the same as what we're looking at in the policy of 4.89, a little bit more in the policy. Now I've done one for a 27-year-old male, okay, also a non-smoker. So you women out there that are watching this going, why is he just choosing men? Simple. Mortality rates for men is quicker than it is for women. So if you're a woman watching this and you're somewhere near 27, please understand that this internal rate of return would be even higher on you than it is on a male. So I'm trying to be conservative by using a male, understanding that a male's numbers are going to be lower than a female's. Okay? So again, I'm running it out until he's 87 years old, the average, and he's getting 5.23. And as I just pointed out, that means as if he had made 5.23 every single year without paying any taxes. And so to get an actual rate of return out of the stock market, where you would need an 8.6 average rate of return to equal the 5.23 in a non-taxable environment. Again, using a miscellaneous fees of 1.5 and 25% tax bracket. But what if I move this tax bracket up to 30% and I take the miscellaneous fees to something more representative of reality and take it to 2.5? Now look what it takes. An average return of 10.3 to equal an actual rate of return of 5.28. Let those numbers sink in a minute. Again, the taxable bucket, the non-taxable bucket. Well, this is representative of what the non-taxable bucket gets this 27-year-old. Yet we still need to keep in mind a holistic view of what we're dealing with here. Although this is a warehouse for money, it is still an insurance policy. So our 44-year-old, if he were to pass away at age 89, his family would end up with an internal rate of return of 5.37. Even though he can borrow against it and take out all that money and have it available to him at 4.89, his family's still going to end up with even more money, almost $2.7 million, tax-free, if he keeps this and passes away at age 89. And keep in mind, he quit paying any money into this thing at age 65, right there. So it just continued to grow. He never had to put any money into it, and it continued to grow and kicked out at the end $2.7 million to his family when he passed away at age 89. This is, again, an internal rate of return. It's an actual guaranteed rate of return. No fees, no taxes. It's a different bucket than the stock market. Look at this rate of return. If he were to pass away after 5 years, 77% internal rate of return. And I know I don't want to think of death as a IRR, but the reality is if he made it to age 59 and then passed away, that's a 15% rate of return, internal rate of return. But what about our 27-year-old, right? He's starting out with a death benefit of $2 million. If he were to die in year one, that's a 12,000% return on his family's investment there. But again, we're saying he makes it to 87, and even so, it's 5.65 internal rate of return every single year. If he makes it 10 years, which he probably should, 43%. If he makes it 20 years, 16%. You get the idea. So what becomes important here is understanding that when we compare apples to apples by actually by making a taxable bucket like unto a non-taxable bucket, what ends up happening is that it takes almost twice as much money in your taxable bucket to get what you get in a non-taxable bucket. Okay? So just keeping that in mind. Again, I'm not trying to say never invest in the stock market. What I'm saying is you've got a threshold that's actually providing you somewhere between 8 and 10%. So unless what you're being offered is going to get you or has the potential of getting you in a risky environment much more than what you get in a guaranteed environment, make your decisions wisely. Thank you.